Hey traders, Jason here from Leavitt Brothers. Happy Monday, happy New Year's. It's nice to get back into a groove since the last 2 weeks were interrupted by holidays. Finally, we get a full week of trading. We get 2 of these before the next holiday. So in today's video, I'm going to do an overview of how I view the market. Okay, I'm going to discuss the indexes on a few time frames and then dig into the internals to gauge whether the movement of the indexes is supported. Before I get started, quick reminder, my masterclass in trading is available at teachable.com. There's a link below this video. Okay, so let's get started. First we're going to check out the indexes, then we're going to check out some of the internals. All right, so here is the S&P 500 monthly going back 30 years. So obviously we have a big trend up, we have some sideways movement, and then we have another trend up. So there are some traders in this trend over here. I mean, I have the chart going back to 91. The trend actually starts back in like the early to mid 80s. Okay, so there are some who will say that this is like a 15 to 20 year bull market, and therefore we should have a 15 to 20 year bull market here. And there's a lot of evidence that says that's entirely possible. I've discussed it in other videos. Maybe I can do a refresher. But there's evidence that's possible. So if indeed that happens, if the current bull market started in 2009, then we might only be maybe halfway through. I mean, at the very least, we could have 5-6 years to go, possibly as many as 10. If you use the new high here as the beginning of the bull market, then we might even be like in the first half of it, and we could be at that point in time we could easily go to 2025, 2030. Okay, so it's just this just gives us the big picture. Again, some like longer term technicals would support the fact that we had a 15 to 20 year bull market, then we had a range in a 15 to 20 year bull market that goes the same percent as the first leg over here, would have us going up, easily to S&P 4,000, even much higher by the year 2030. Okay, so this is the big picture. There'll be interruptions, there'll be disruptions. You could see, on this monthly chart, you have a test of the 50-month moving average, which is actually fairly common. Test here, test there. This thing could push up and come back down, and we can have a stiff correction, and we can have another test of the 50-month moving average, a year from now, 2 years from now, who knows. But the trend is up, and the long-term technicals would support a continuation of the trend well into the 3000s and well into the 2020s. All right, here is the same chart, but it's the weekly version, so I don't have any really new comments to add, other than just pointing out that the 200 on the weekly has been a key level. It was a key level. I mean, historically, if you look at charts going back 100 years, you get a consolidation period, like this. Then you get a big, long rally that lasts 15 or 20 years. And in that 15 or 20 years, you get a test of a key moving average, and then a rally and a test and a key moving average, and a rally and a test of a key moving average. And you tend to get 3 or 4 tests over the course of 15 to 20 years. So it's possible. I don't know what's going to happen. Anything could happen day to day, week to week. There's going to be disruptions and such along the way. There's going to be corrections. There's going to be 10% pullbacks, 20% pullbacks. But the big picture says stay long, because we could be going much further and for much longer. Zooming in, here's the daily. The 21 EMA has been a really good support and resistance level. You can see support all the way here, resistance here, support on the way up, little resistance here. Nothing really going on here, but then obviously really good support here. So in the current state, until this thing falls below the 21, comes up here, gets rejected, because the 21 will end up kind of going like this, gets rejected and starts going down, you got to favor the long side. Okay, the trend is up. When the chart goes from the bottom left to the top right, that's the definition of an uptrend. Until the 21 EMA gets taken out and it fails to reclaim that level, like in a decent amount of time, I think bias has to be to the long side. All right, let's look at some of the internals. All right, down below is the cumulative 80 line at the NYSE. It's one of my favorite long-term indicators. It's just simple. Obviously, we're in a nice uptrend. As a point of reference, going back to last year, if we're going to analyze the period before the drop happened here, what you have here is you have the market moving up here, but you have the AD line had already been trending down for about a month, and then a little drop here, and it immediately dropped well below the 50-day moving average. Okay, as a point of reference, you had a drop here, but all you got is a drop basically to the moving average and then a bounce. You had a drop here, and all it did is come down to the moving average. Another drop here, it came down to the moving average. Okay, so in the current state, we're at a new high. There's no divergence forming. The fact that we're at a new high means it's going to take at least a month for a divergence to form. The AD line says you got to be long. Okay, zooming in a little bit closer, divergences with the 10-day AD line tend to warn of minor pullbacks. Okay, so you had one here, you had one here, a little bit one there. But the difference is, or something I should point out, is that when you get a divergence and you get a price break, when you get a minor drop like there, and then it recovers, and you get a minor drop here and it recovers, and a minor drop here and it recovers, as compared to a much bigger drop and then it struggles to recover, and even when it recovers, that it drops back below. So there's a big difference between how the indicator acted over here versus how it acted over here. So in the current state of things, there's no divergence over here, there's no divergence over here, market is supported, you got to be long. Here are the AD lines of the large caps, small caps, and as you can see, small caps, large caps, mid caps, all of them are at their highs. There, as a point of reference compared to the previous big drop. And again, the last big drop we had was October, November, December of 2018. It was in here. Okay, so prior to that, okay, large cap line was doing fine. Mid cap line was doing fine. Small cap line had been starting to decline. But once the market moved down a little bit, look at this small cap line just got crushed really quickly. The mid cap line also got hit pretty hard. Okay, so that's what we want to look for. If the market is going to correct here, if we just get like a minor drop here and then a recovery, minor drop here, recovery, the market will do fine. Okay, it's only if this line actually moved down a lot that I'd actually start getting concerned. So as of right now, with all three of these curves at new highs, you got to be long. All right, here is the Nasdaq versus the Nasdaq AD volume line. Okay, similar to the AD line at the NYSE. So what we have here is we have a huge trend up, mostly above the 50-day moving average. We have, high prints here, far from the 50. As a point of reference, you can see as the market was heading, up and over in 2018, this had flattened out and just a little bit of a move down, and this thing was already below. And then on bounce attempts, it failed to get above the 50 and it stayed here. Whereas bounce attempts over here, obviously it reclaimed here, barely fell below. Okay, so there's a big difference between how the indicator acts when trouble is brewing versus when we're just undergoing just like a relatively minor dip within an uptrend. Given where this is at, sure, we could have a blow off top come anytime, but there's enough equity stored in here that it could withstand a drop. Okay, even if we had like a fairly stiff correction and it came down like this, there's enough of a buffer built in here that it could absorb a pretty decent amount of selling before it actually ran into some trouble. So another indicator that says you got to be long. Okay, and then this is the large cap, mid cap, small cap AD line, AD volume line. So what we have here is you can draw a trend line over here, and we got a breakout. We got high level here. This is matching the highs. This is matching the highs. As a point of reference, again, the last big selling period we had was October, November, December of 2018. And as you can see here, not a lot of trouble. We're not a little divergence there, flat there, no big deal. Nothing is really urgent there. But you can see that once the market moved down just a little bit, this fell off hard. This fell off hard. Okay, so that's what we want to look for. If the market corrects, when it corrects, it'll correct eventually. If these lines just kind of drift down a little bit in base, that's a great sign. That's a sign that the market is supported and we're probably going to go back up. If these fall hard, that tells you there's trouble brewing beneath the surface. So as of right now, these curves are all at new highs. Everything looks good. We'll gauge the situation if the market corrects soon. All right, here is S&P 500 versus NYSE new highs, Nasdaq new highs. What I'm looking for here is one is just the absolute level. Okay. Ideally, we would just get just rolling prints in the middle of a range. That's perfect. Too high sometimes means too much too fast in the near term. Too low is an issue. But if you just get like steady prints in the middle, that's perfectly fine. We have a print right here in the middle of our range. We have a print right here which is kind of falling towards the bottom of our range, but still in our range. So the absolute prints are very good. Okay, we've had a lot of high prints over here, which tell us that a lot of stocks make a new high. Now another thing we want to look for is the trend. Let me delete a couple of these. All right, so we want to look for the trend. So if you as a point of reference, back in 2018, as the market was going up, trend was down here, trend was down here. Okay, so that kind of spelled a little bit of trouble. Maybe we have a little bit of a trend going down here. Okay, we'll have to see. It's going to take a few more weeks for that to develop. Once a trend develops, we get some sort of negative divergence. If the market cracks and breaks down, what you want to look for is do the indicators fall to a low level and bounce, or do they fall to a low level and stick there? So you can see it like fell to a low level and stuck, fell to a low level and stuck. Whereas over here, we got drops down, recovery, drop down, recovery. Look at all these touches along this bottom line here, in quick recovery. Same thing here. Okay, so in all cases over here and here, the market, the indicator dropped, but then it recovered, whereas over here it dropped and then it just stayed there. Okay, so that tells us that trouble is brewing. So right now, absolute prints are good. Trend is fine. It's going to take a little bit longer for any type of trouble to be signaled. And then even if we do get a crack in the market, as long as we could hold in the range here, the market will be fine. It'll recover whatever selling takes place. All right, zooming in, here is the new highs with large caps, mid caps, small caps. Okay, a couple things I want to look for here. So I want to see what the absolute levels are. I want to see if if there's a divergence where maybe large caps are printing new highs, but mid caps and small caps aren't. And then I also want to see trend, and I want to see how long the prints are at certain levels. Okay, so for example, right now we have pretty good prints here. Okay, I'd consider this to be healthy. I'd consider this to be healthy. Small caps have fallen off, but still at a decent level. If you compare that to the last time the market had trouble, we had a mid cap line fell off and then stayed pretty low. Small cap new highs were had been dropping for more than a month, and then when the market started to get weak, they were really low for several weeks. So I don't see any evidence of that right now. Okay, a little bit of pullback recently. Maybe it's because of New Year's and then trading was a little bit slow. We'll have to see over the next week or so. But I still see pretty good prints. And I don't see evidence that the market really has some trouble internally that we should really be concerned about. Okay, here are a couple more charts. Here is the percentage of stocks, percentage of Nasdaq 100 stocks above their 50-day moving average, percentage of Nasdaq stocks above their 200-day moving average. Okay, I want to look at the print. I want to look to see if any divergences are forming. So obviously with the prints, this is high level. This is more than a 52-week high, so the prints are good. As of right now, almost 70% of NDX stocks are above their 50s. More than 55% of stocks are above their 200s, which relative to the past is a really good print. If you compare this to, again, the previous big downturn, you had a divergence here, slight divergence here, but that's not as meaningful. And that's just not happening right now. This was you had a divergence here forming over the course of 2 months, and here we have a new high. So the market is supported. Almost 70% of stocks are above their 50s. Historically, this is a good print, and we're not, and the print is getting better, not worse. So you got to be long. Last chart, similar concept, S&P 500 versus the number of stocks that are above their 20, above their 50, and above their 200-day moving average. Okay, so what you want here is you want just steady prints within a range above 50% for the 20, and you want steady prints within range above 55% for the 50. It's exactly what we're getting. With the 200, you just want steady prints above 50%, which is perfectly fine. Now, when the market runs into trouble, you get like divergences, like right here. So you got market pushing to a new high, divergence here. It leads to the market dropping a little bit. Okay, it happened again here. Market pushes higher, divergence, market gets weaker for a little bit. Okay, it happened in 2018, same thing. Market goes up, divergence, market cracks. Okay, so what we want to look for is a divergence that signals maybe there's a little bit of trouble brewing. Okay, right now I don't see it happening. I mean, with the indicator move down just recently, it's going to take a few weeks for a divergence to form, kind of like this. Okay, once that forms, we want to gauge how far it goes below 50% and how long it stays there. Okay, so we had a dip below 50%, but it never got lower than here. And if you compare that, it basically got to zero here. Okay, so the dip was a lot bigger, and then it stayed below for a much longer period of time. Okay, so the way that this indicator acts is it forms a hint as to how strong or weak the market is. If it dips below, that's normal. That would be considered a correction within an uptrend. As long as it bases and recovers, the market's fine. But if it drops really low, that's a sign that the market's a lot weaker than we thought. So as of right now, we got really good prints, well into their ranges, and if a divergence is going to form, it's going to take a couple weeks for a divergence to form. All right, so overall the market's in great shape. I don't see signs the top is forming. The trend is up. The internals support the strength. Anything goes day to day, anything goes week to week, but the evidence would suggest that even if a correction did play out, there's enough internal strength to absorb the selling and send the market back up. Okay, thanks for listening. Again, check out my masterclass at the link below. It's free. See you next time.